Hey everyone, welcome back to Corporate Decoder, the place where we break down the cryptic world of finance with a healthy dose of smirky sarcasm. Today we're diving into ManpowerGroup Incorporated's latest quarterly report, a document that's usually a snooze fest. But we promise by the end you'll feel like you are fluent in corporate speak. Before we get into the nitty-gritty, if you love getting straight talk on company financials without all the fluff, make sure you are subscribed. And hey, we've built a fantastic community Discord channel linked right below where we dissect these filings together, so join us there. It's like a secret society for finance nerds. Alright, so this is their quarterly report, a 10Q filing. Think of it as a progress report for the last 3 months, giving us a peek under the hood of ManpowerGroup's financial engine. Let's kick things off with the balance sheet. This is like a snapshot of everything the company owns and owes at a specific point in time. As of the 30th of September this year, the company had total assets of about $8.4 billion, which is a pretty big number. Now, look at their liabilities, that is what they owe. Total liabilities are close to $6.4 billion. Digging a bit deeper, their current liabilities, which are debts due within a year, jumped to over $5.1 billion. That is a significant increase from the end of last year. This increase is largely driven by a big jump in short-term borrowings and current maturities of long-term debt. It looks like they've taken on a lot more short-term loans. Now let's look at shareholder equity. That is what the owners of the company actually own. It was about $2 billion. This equity took a bit of a hit compared to the end of last year, showing a decrease. This is often due to things like share buybacks or dividend payouts, but also can reflect a dip in overall profitability. Moving on to the income statement, this tells us how much money they made and spent over a period of time. For the 3 months ending the 30th of September, their revenues were a little over $4.6 billion. That is up from last year. However, their cost of services also went up, leaving them with a gross profit of about $768 million, which is actually down from the same period last year. This means their gross profit margin, a key indicator of how efficiently they are producing their services, dropped from 17.3% to 16.6%. Imagine you have $100 in revenue. You are now keeping about $1 less for yourself after covering the direct costs of delivering your service. And when you add up all the costs and expenses, including things like interest on debt and taxes, they ended up with a net earning of $18 million for the quarter. This is a notable drop from the $22.8 million they reported last year. On a per share basis, that's about 38 cents per S-hair, down from 47 cents last year. It's not a massive drop, but it highlights that while revenue is up, profits are shrinking. Now here is something interesting and a bit concerning. The company took a big hit for impairment charges. They had to write down the value of some of their intangible assets, like goodwill, by a significant amount, specifically $88.7 million. This often happens when an acquired business or asset is not performing as well as expected, and its real market value has fallen below what the company originally paid for it. It is like realizing that collectible item you bought is actually worth much less now. Their goodwill balance, which represents the value of a business that exceeds the fair value of its identifiable net assets at the time of acquisition, took a hit. It dropped to $1.54 billion from over $1.56 billion. They explicitly mentioned goodwill impairment for their United Kingdom and Switzerland reporting units, totaling $58.1 million. This indicates that the businesses in those regions are significantly underperforming. This impairment charge, along with other factors, is a big reason why their net earnings for the first 9 months of the year are in a loss of over $43 million, a stark contrast to the $122 million in earnings they had last year. This is a red flag. This impairment is also a significant factor for their effective tax rate calculation, which is sky high at over 256%. That is because these non-deductible impairment charges mess with the tax calculations in a big way. Let's look at cash flow. The company used significantly more cash in operations this year, about $283 million compared to generating $61 million last year. A big chunk of that difference comes from changes in their operating assets and liabilities. Essentially, they are needing more cash to fund their day-to-day business. Investing activities also used more cash, mainly for capital expenditures, which are investments in property and equipment and acquisitions. On the financing side, they saw more net cash provided by financing activities this year compared to last year. This typically means they've taken on more debt or issued more stock, which we can see with the increase in short-term borrowings. Their total debt increased substantially to over $1.2 billion from about $952 million. This increase is largely due to increased borrowings on their revolving credit facility and the fact that they've shifted some long-term debt into current maturities. This brings their debt to capitalization ratio up to 37.7%. This ratio shows how much of their company's value comes from debt versus equity. While not alarmingly high, the upward trend merits watching, especially combined with the profit dips. Looking at revenue specifically, their Americas segment saw solid growth, around 4.6% in the third quarter. The United States, their biggest market within the Americas, saw a slight dip, but other parts of the Americas region are picking up the slack. Southern Europe also showed revenue growth, largely due to favorable currency exchange rates. However, Northern Europe and APME saw revenue decreases. The gross profit margin across the board has taken a hit. For the entire company, it's down about 70 basis points year. Over year for the quarter, this suggests that the cost of providing their services increasing relative to the prices they can charge. This pressure on gross margins, combined with increases in selling and administrative expenses, has squeezed their operating profit margin. It is down to 1.4% from 1.6%. This means for every $100 in revenue, they are keeping less profit after all operational costs. Now, let's talk about operating unit profit, or UP. This is how they measure their segment profitability. Notice how in Northern Europe, their UP margin actually improved significantly, going from negative 3.1% to negative 1.8%. This is an improvement, but still in the red. The API region also saw an improvement in UP margin. However, Southern Europe's UP margin took a dip. Looking at the big picture, ManpowerGroup is navigating a complex global economic landscape. They are seeing revenue growth, which is positive, but it is being eroded by rising costs and significant impairment charges on some of their past acquisitions. The increased borrowing is a tool to manage their working capital needs, but it also adds to interest expenses. The company is clearly facing headwinds, particularly with some of its international operations. The impairment charges are a signal that some strategic decisions in the past are not paying off as expected. While they are trying to manage costs and improve efficiency, the overall profitability is under pressure. The big question is whether they can turn around these non-performing segments and manage their debt levels effectively. So, what's my take? ManpowerGroup is showing resilience in a tough market, particularly with revenue growth in certain regions. However, the declining profit margin, significant impairment charges, and increased debt are areas that investors should closely monitor. They need to demonstrate a clear path to improving profitability across all segments and ideally reduce their debt load. Their strategy of focusing on stable regions and improving efficiency in others is sound, but the execution needs to deliver stronger results. Alright, that is our breakdown of ManpowerGroup Incorporated's latest quarterly report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives, and don't forget to check out the Discord in the description for more insights. Thanks for watching. See you next time.